You still have property, right, which is where the underlying consumer holds 70% of their wealth. You've had rate cuts to stimulate kind of demand in that segment. But ultimately, it takes time to get through a supply and demand mismatch, which is what you have there, and concerns around continued property price declines. So you need to come in with significant fiscal stimulus to spur consumer demand, or the rally, I think, will tail off. I mean, really what we need to see ultimately is obviously all of this translate into underlying economic data, which will just take time.
What about your own allocation?
Yeah, so our allocation, I mean, as you know, it has been quite painful because we have been overweight China.
JD.com?
Exactly. We have been overweight China, particularly relative to a global portfolio. I mean, for us, about a quarter of our global portfolio has been invested in Asia, which is largely China, against 2% in the benchmark, which has clearly been contrarian. But if you look at the underlying fundamentals of the companies, they've still been growing. They generate a lot of cash. They've been inexpensive, all the reasons that we've chatted about. Even after the rallies, right, they're certainly more expensive than they were 7 days ago. If you look on an absolute basis, they're not particularly expensive at this point. So we haven't made any changes. I mean, obviously, it's very path dependent. If the rally continues on the same pace as it has been on, then maybe in 5 days we would consider changing.
How much has your conviction in the markets changed on the back of this fiscal stimulus? To say, okay, so I put in money at 100, that 100 became 10, now the 10 has become 50. Do I get out at 50, average out my costs, and get out at 50, take the profits that I get, or I think that this is going to be conclusive enough to go past the previous price of 100?
Yeah,
I make incremental gains.
It's a great question. So and it really gets to portfolio construction, I think, as much as it does to investing in the underlying individual names, right? When markets were exceedingly inexpensive, we were adding to positions. So we don't need to move up materially from here to be back in the green, even though markets from peak to trough for some names were down 90%. For us, what we try to do is you really need to marry two things. One, look at the underlying fundamentals of the companies, which are still attractive and still trading at reasonable valuations, but also be measured in how large that exposure gets as a percentage of your overall portfolio. And I think for us, that's what the challenge will be, right? We were at 25% already. I think 40% in a global portfolio is too high. So for us, regardless of underlying fundamentals. So then you're 20 times the China weight. So as the rally continues, we will be naturally forced to pare back the Chinese positions that we have. But even if we do that, we will still be quite overweight markets from here.